Good evening, everyone. This is Joseph Trevisani from Worldwide Markets. I thank you all for attending, wherever you are in the world, whatever you are doing. I take it as a great compliment, as you know, that people take time out to listen to what I have to say. Brief note, I have the various chat systems from FX Street up. Of course, I would like to thank FX Street for their facilities for putting on these webinars. If you have any comments, criticisms, and although I ask for it many, many times, I never get any jokes, please type them in so we can all see, and I will comment on them as quickly as is sensible considering what I'm talking about. So today's topic is a very descriptive term. It's one we must all thank whatever journalist who came up with it, and I'm assuming it's a journalist, because it is extremely descriptive of what goes on. The title of this particular webinar is Helicopter Money, What It Means and Where We're Going. That wasn't actually the title, but that's my paraphrase of the title. As if the premise on so many things that are conducted in and described in the financial system, in the financial world, as if you are approached as if we have something new in hand. Financial markets like new. They don't move pretty much except on new. I remember a number of weeks ago, we spoke about the Chinese yuan. In last August, the Chinese yuan was unexpectedly devalued by Beijing. Markets went bananas. Equities, huge hit. Same thing happened in January. That huge swoon in the equity markets was largely based on a reaction to what was going on with the Chinese yuan. Well, where's the Chinese yuan now? I don't have a chart, but I will tell you. The Chinese yuan is below those levels. The dollar yuan is above both of those events. There has been zero interest from the markets. Zero. If ever there was a more important or telling fact out of the China, then the yuan, I can't think of it, because their figures are, if not fudged, they are at least, as the rather inelegant term that gets used sometimes, goal-seeked, meaning simply somebody says what they want, and lo and behold, the statistics prove that. So the interest in the markets, being a creature, as if it were, with a very short attention span, is new. The new is what gets the market's attention. The reaction we've seen from the yen, I mean, this is not a great chart. Let me find if I can find a better chart for you right here. Where's the yen on this thing? Is the yen on here? The yen is not on here. Oh well, okay. Let me go back to the chart I had here. I don't want to spend too much time on this one. Okay. So here we go. This chart we had before. It's a long-term chart, so you don't see it very much. But this bounce here at the very end in 2016, in the end, where the dollar yen starts to go back up, which of course is the goal, one of the goals of the current administration, Abenomics, and the rest. This entire process here, from here to here, is based on the campaign and the election of Shinzo Abe and his 3 arrows to revive the Japanese economy. A number of things we can say about it. One is that the threat of what they were doing was very effective. The yen went up almost 50%. Hugely effective. The other 2 arrows have not really taken place. That's another story. Again, we have here the principle of new. Mr. Abe's program, the government deliberately behind an attempt to devalue the yuan, was something markets responded to, and they did basically all the work. Central banks are most effective in monetary policy, but also in currency policy when they can get the markets to do their own work for them. Well, this bounce, again, this was new. Markets responded. Back in August, a deliberate devaluation of the yuan, despite what the Chinese government had said that they will keep the yuan stable, was new. The markets responded. Right here at the end, I know it's not a great graphic, but I'm interested in long-term effects here today. What is that little bounce? Well, it is today's topic, new. Helicopter money. Great term. Visions of, fleets of helicopters dropping money over Tokyo or money over New York or money over Kansas, wherever it is. Probably not so much Kansas because it's pretty much an empty state. It's a farming state. That's a new policy. It's only been spoken about so far in sort of the most theoretical terms. But is it, and this is my point, is it really new? What is new about it? And is there any reason to expect it to be successful? Let's go back to the entire history, which is one that we keep repeating and keep repeating and keep repeating. It's sort of like being in, Bill Murray movie Groundhog Day, where you keep repeating the same thing and hoping it'll come out differently. From 2008 on, what has been the uniform approach of the world central banks, the custodians of the world economy? They shouldn't be, but they are, by default. Politicians will always defer the hard. I do see a comment, but I'm not sure what. Oh, GM most likely means good morning. Good morning, everyone. Thank you. Sorry, I was pretty quick on that. It's either that or it's genetically modified foods, but it's probably not. It's probably good morning. Good morning. The uniform response. Let's take a look at the response. This is the response of the Bank of Japan. Here we are, 2008. Where are we here? This is Bank of Japan assets. Let's look at Fed assets. We all know where this is going, but it helps to see things sometimes. Fed assets. Whoa! If that's a roller coaster, it's one way and it's a pretty rough ride. Okay, it looks more like a space shuttle launch. Response of the Fed. Let's look at the ECB to 2008. And we have the ECB here, ECB assets. Are we going to see the same thing? What do you think? Anyone want to put any bets on this? Now, this is not new to anybody. Everybody knows this. The response of the world central banks has been uniform. Flood the markets with credit. Make money easier. Within the context of their actual powers, this wasn't just an inevitability. It was a guarantee. Maybe they mean the same thing. They really had two policy choices. Do nothing or do the only thing they can do. There really weren't any other policy choices. And so, not surprisingly, with some degree of coordination, how much, I don't know. I don't think there is a secret room where all the world central bankers meet, maybe in some fifth dimension where they all converse and then go back to their central banks and their buildings and their cities and their governments and start doing what they agreed to do. I don't think that's the case, of course. Be a much better narrative, I suppose, if it were, but it's not. Nevertheless, the reason the banks all responded is because they had no choice. The only alternative would have been to do nothing and then say, this is the right policy. Since that clearly was, at least in the beginning, probably not the right policy. And other banks are already doing it, starting with the United States. Everyone eventually came around. There isn't any central bank in the world of note that is not following this policy. The Fed, the BOJ, the ECB, and the Bank of China. Those are the four largest economic blocs, countries, nations, whatever you want to call them, in the world. Every one of them has bought into this policy to the hilt. There are differences in execution. There is absolutely no difference in policy. One can. Two questions need to be asked, and this relates directly to our topic today. Are any of the steps that have gone from 2008 on that have taken place, that every bank has followed, really different policies? This is important. Or are they all a continuation of the original policy, flooding the market with liquidity? And the reason it's important to ask this question is because markets tend to respond to new, but are they responding to new names, which would be my contention, or new policies? And a question which never seems to get asked, do the policies work? Is there any expectation, is there any reasonable expectation that we have a change in policy that might produce a different result than the policies that have gone before? So let's take a look at this. Since the Fed ran the table on this one, so to speak, let's take a look at Fed policy. Now, I deliberately did not put interest rates on this. There have been three approaches to this policy, my contention. It's my contention, I'm going to tell you up front, that all three of these, two in effect, or two which have been tried, one which is still waiting, that would be interest rates, zero interest rate policies, then quantitative easing, and the one we're still waiting on, of course, the very felicitously named helicopter money, are all the same policy. There's no difference. Once we look at that, we should make the next, because if we accept that, and I'm going to, I hope, demonstrate, or at least explain why I think that's true. If that is true, since I've not made my case yet, I will take it as a hypothetical. If that is true, that all three of these policies, exemplified by the Fed, which has been in the forefront of this, and the chief and leading exponent of it was former Fed and is former Fed President Ben Bernanke. If it is true that all three of these policies are the same, an extension, a building, a compounding of one policy, then the next step we have to take, of course, is to see if the policy is effective. Has it achieved the goals, nebulous as they may be, of the central bank? Once we can look at that, we can then take an estimate backwards as to what markets are responding to. And I'm specifically talking about equity markets. We all know, at least here in the United States, the two biggest stock indices, the Dow Jones Industrial, and the S&P, are at record highs. I think the Dow is around 18.5.5, if I remember. I didn't check before I came in. And the S&P is around 2120. Again, I forgot to check before I came in. But anyway, they're both record highs. The point being that they're record highs. The ostensible purpose of equity indexes to discount price future earnings, the future course of the economy. It is very difficult to justify, logically, equities at all-time high in the current state of the U.S. economy. Now, people will make an argument, and I've heard this argument a number of times. I heard it on the way in this morning, that the economy is doing quite well, that unemployment is low, that growth is stable. That's debatable. Of course, if you look across the last couple of quarters, we're running about 2.4%. So the Atlanta Fed says this quarter we were 1.1 and then 1.4 before that. That is hardly, it seems to me, an economy booming at record highs in equities. Let's take a step back and see if we can establish that the two policies which have been enacted and the one which is supposedly waiting in the wings or in the upper atmosphere, the stratosphere, I suppose, are really all the same policy. The purpose of zero rates is to do what? Rhetorical question. The purpose of zero rates is to get people not, and I'm not talking about the results, but the purpose. We'll talk about the results in a minute. The purpose of zero rates is to get people spending. How do we accomplish that? Well, we don't pay them any money, or we charge them money, negative interest rates, same thing, with their bank accounts. So corporations don't keep their money on deposit. People don't see any point in saving because they are not getting any money out, so they go out and spend it. That's the purpose of low interest rates. However, low interest rates have a limit, or at least they do in setting rates, or banks have determined that they don't. Well, let's put it this way. When low interest rates were the policy, nobody determined to set rates negative. So when that was not seen to be sufficient in the United States, what do they mean? They mean that rates weren't low enough. What was happening was that even though the Fed was setting the base rate, the Fed funds rate, I don't think I brought any rates. Let me see that. I mean, I've talked about rates so many times in the past that I didn't want to go down that road. Okay, we didn't. So interest rates were set at zero, but commercial rates, which are the rates that the market really, that the economy really operates on. It's very nice that the Fed funds rate is 0.25% or whatever the actual effective is. But if your 10-year rate is still running at 3%, the idea behind this is you're not getting the result that you want. That 3% or whatever rate it is, 2%, may have been a historical low, which would tell you that your zero interest rate policy is working. It took interest rates to their historical low. But the Fed judged that that was not low enough. So then the Fed began their various quantitative easing programs, which do what? They go out into the market and they force bond prices higher and rates lower by actual purchases in the market. Again, the idea, the purpose is exactly the same. Reduce the cost of money, reduce the incentives to stay, shift the money from bonds to equities, make people feel wealthier, and make people spend. So we can, I think, agree that the two policies have as their goal, and even as their mechanism, the identical purpose and the identical method. No, let me rephrase that. The identical purpose. The method is different. Obviously, if the Fed is going out into the market and buying corporate debt to lower interest rates by forcing the market, by forcing prices in one way and rates in another, that's a different method of execution, of course. So the goal is, and remember, the kind of the three pillars, not Mr. Abe's three arrows, but sort of the three poles of spending, GDP, in the United States, and it's true everywhere actually. It's just that the United States, I kind of know the percentages for GDP, national gross national product, are consumer spending, business investment, and government spending. Well, the biggest one by far, of course, 70% or so, is consumer spending. So you have to think that the focus is consumer spending. That where you're going to get, hopefully, the greatest amount of bang for the buck will be by inducing consumers to spend. Consumers need to spend. Well, there's a fallacy in this that we discovered, but we'll talk about it in a minute. So the last iteration of this particular policy, now we need to, is helicopter money, as it's called. It's never been tried anywhere as far as I know. So you can look at it in various ways. I read before I came in an article in Bloomberg about just this. And their description of this, I'll quote you exactly, said this is about Japan. They're considering the policy known as helicopter money. And then he goes with a hyphen saying, giving you what that's supposed to mean, direct financing of government spending by the central bank. Now, I would disagree with that, because what exactly is going on in Japan and has been going on for some time? Exactly that. There is one difference. To whatever degree, and I'm not really sure of the number, the government spending in Japan is deficit provided. That means the government doesn't really have the tax revenue coming in. They issue bonds, which people buy, and they give the government the money. The government spends it. Use it to pay bills, build bridges, whatever they do, pay pensions. Those bonds are generally sold to the public, institutions, even individuals, on and on and on. What's been going on in Japan? Well, in Japan, exactly of what that phrase says is supposed to happen with helicopter money has been going on in Japan for some time. The BOJ buys almost all the debt issuance of the government. Actually, it's been going on here as well. Was going on while the Fed was doing its quantitative easing. So there already exists direct financing of one part of the government by the other. This is sustainable as long as people believe it's sustainable. And as long as there are no real alternatives for so many institutions as to where to put their managed client, whatever their money. Does it make a lot of economic sense? We can have an argument about that. I'm going to do part of it in a minute. Okay, so as far as the government goes, the last phase of the three policies, zero interest rates or low interest rates, quantitative easing, and helicopter money, are, when enacted through the government, the last one, helicopter money, are essentially the same. What happens when the government issues bonds and they're bought up? Rates go down. Doesn't matter whether the bonds are existing, that means the secondary market, or new issuance. The result is you drive bond prices up and interest rates down. So as far as the government policy goes, as described in this Bloomberg piece, direct financing of the government, there is no essential difference between any of these three iterations of what are basically the same policy. Interest rates, quantitative easing, helicopter money are all the same policy. Their methods are different. but the purpose and the result is the same. Drive down interest rates. And that's true here in the United States as well. Zero interest rates, they're much more, I would say, upfront about the policy here. Zero interest rates, low interest rates, quantitative easing are the same policy. Markets respond to them. Why? Well, it seems when you start quantitative easing, it's a new policy. It is a new policy in the sense that it was not something that was done before. Regardless of whether, in fact, the result and the purpose of it is the same thing as far as monetary policy goes. So the markets responded to that. They also responded very quickly, or learned very quickly, that the result of this policy is a whole lot more liquidity to prop up markets. And here I think you have the split, the dichotomy, if you will, between the goals of the policy and the results of the policy. The policy, and I'm going to make one caveat on this in a minute, but right now I'm not going to. Of these three aspects of monetary policy, this is all monetary policy by another means. Arose by any other name remains Gertrude Stein's famous phrase. Arose. The purpose of all these policies is to lower interest rates and get people to spend. So first, let's take a look at the effect of these policies. And I'm going to use Japan because Japan has gone further with this, but I'm going to talk about the United States as well. Okay, this chart has three things on it. Not a particularly felicitous chart, I know that. The white line, Japanese interest rates. The overnight call rate, I think it's called. The yellow line, BOJ assets, their quantitative easing purchases. And the green line, quarterly GDP, seasonally adjusted annual rate, the famous SAAR rate. Okay, so let us take a look. Now you can see that this is Japanese rates right here. This contents right here, and you can see that for more than 20 years, Japanese overnight call. Oops, hold on. Yes, I'm just seeing that now. Sorry. The Japanese call rate has not been above 1%. Okay. Looking at that, and I know the scales are a little bit off, but let's just look at it, what we have here. The interest rate policy of the past 20 years in Japan does not seem to have produced much of a change at all in Japanese GDP. The Japanese rates, for the large part, have been at 0.1% or less, with a few exceptions of a couple of years, since, about 1998, 18 years. And the best you can say for the Japanese economy in that period is it's been fitful. So let us look back here. Now, what is going on down here? Of course, we'll talk about that in a minute. Now, I have not checked what Japanese current sovereign debt is issued at. I think in Japan, in Germany, it is being issued at negative rates, but I'd have to check that. But it doesn't really matter because the result is whatever the coupon is, markets will adjust the price to produce the market rate. So the Japanese are issuing, rates down below zero, the Germans and everybody else, I'm not sure. But it doesn't matter. There are both private and public, meaning the BOJ, entities in Japan willing to buy JGBs at negative interest rates. You wouldn't have it here if it weren't the case. But as we can see from the chart, and certainly from the very, very rapid rise in assets, there hasn't been a great deal of effect on the economy. Let's take a look at the Fed assets and GDP. Okay. Okay, this is Fed assets and GDP, the same chart before. That's a great slope going down if it's a ski slope, but I don't know what it is if it's going up. It's a very errant rocket if it's going up. But again, the same thing here. Within a degree of variation, quarterly, there has been very little discernible effect from these extraordinary, we're running on close to a decade now of zero interest rates. The purpose, remember, is to create, these were originally emergency policies to create sustainable growth, economic growth. Yet they keep getting extended into other permutations of the same policy because, as far as economic growth goes, they're not working. You have to ask the question, which no one is asking, at least no one in public at the central banks, are these policies doing more harm than good? Again, Japan and the United States, looking at the same time frame with the same inputs, graphic inputs, we can see that there is no sustained elevation. The variation in US GDP, once we came out of the recession, from here to here, to here, to here, to here, to here, is what? It's remarkably consistent. Fed assets are going up. They plateaued here. And what have we seen? Any change? Nope, not really. So you have to ask, why is this happening? By the normal economic equations, you change one side and then across the equal sign, you get a different change in the other variables. It doesn't seem to be happening here. In Japan, let's go back to this chart. "20 years of zero interest rates." Remember, zero interest rates, quantitative easing, ostensible helicopter money are the same policy. 20 years of interest rates. And look at the variation in GDP. There is no pronounced upward tilt. It doesn't work. Look at assets in Japan since 2008. Any change in GDP? Yes, it goes up and down, but the variation, the amplitude, is the same. There seems to be no sustaining effect. It does not seem to be acting as a catalyst. If anything, low rates seem to be acting as a cap. There is 0 sense anywhere in the world, in any economy in the world, of an acceleration building up, or let alone being demonstrated. What can we sort of imagine from this? Let's think about it. If we go back to the 3 largest areas, specific criteria for spending just in an economy, the United States economy: consumer spending, business investment, government spending. How are 0 interest rates likely to affect, not aside from the hoped for effect from the central bank that it would encourage people to spend, who are they expecting to spend? And this, I think, is where the policy deviates from the equations and becomes a problem. And it's not going to change, I feel, with the program called helicopter money. We either, as depicted for government spending in the Bloomberg article, or I think in a more likely occurrence, which would be consumer spending. So what has been the result? One of the things that seems to have surprised everybody. I mean, well, let's take a simple example of it. How many times when gasoline prices started to come down, that we heard from economists everywhere, analysts everywhere, not from me, certainly from the Fed, ad infinitum, if you will, ad nauseum, there's going to be a pickup in consumer spending because the consumers have more money in their pockets because gas prices have come off. Now, maybe it's true that all of the Fed central bankers, all across the country, although I find this hard to believe, this is very much a driving country, take public transport to work, either subways or the MRT in Washington, or they get, cars paid for by the government. They are the head of the various regional central banks. So they don't have to worry or think about gas prices. But that can't be true because they all have cars. They're not going to get a government car everywhere. So everyone understands what this means. And what does it mean? Well, one, it's not a lot of money in the family budget. And two, everyone knows, having lived through the past 40 years since the first oil embargo during the 73 war in the Middle East, what goes up comes down, and what comes down goes up. You cannot, or at least you should not, increase long-term spending as a family or a business based on a transitory price change. Now, the Fed seems to understand this, at least they talk about it a lot, in relation to inflation. All of these price changes are transitory. So they use their core inflation numbers. But the same analyst, the same institution will expect people as consumers to respond to the same stimuli in a different fashion. The Fed understands, or so they say, that price changes are temporary, at least in volatile commodities like oil. But nevertheless, we're all supposed to go out and go crazy spending. And guess what? It didn't happen, of course. What did happen? People's savings rate went up. What particular type of consumption did go up? Transitory consumption. People went out and got a few more meals in restaurants. That's how. So when they got a benefit from lower gasoline price, what did they do with it? They saved it. Now, why would they do that? And again, the logic, which is evident in the empirical logic, is evident in the data, is quite simple, but it didn't seem to have dawned upon anybody at the Fed that this would be the case. Remember where we are. The three parts of spending: consumer consumption, business investment, government spending. The biggest part, in the United States, 70%, others probably less, is consumption, household spending, individual spending. So if you want to affect a change in the economy, that's where you've got to have your effect, because it's the biggest section by far. And government spending has been essentially stationary in the US for some time. And if business is going to invest, they need a reason, the reason being sales back to consumption. So I think I've mentioned this before, but I'll mention it again. As a policy input, the effect of low interest rates on consumption has been far, far less than both expected and hoped for by the economic planners at the Fed and in Washington. And why would that be the case? Well, what's the purpose of spending? What's the purpose of saving? The basic purpose of spending, of course, is to stay alive, clothed, housed, and fed, and entertained, I suppose. And what's the purpose of savings? By and large, it's for when you are not working. And what are the two components of that savings for retirement? One is input and how much money you're putting in. The other is compounding. How much are you earning? How much do you need to put aside at a specific return to end up with a sum that you think is sufficient for your retirement and old age when you're not working? And what effect do zero interest rates have on that formula? Well, quite obviously, it destroys the compounding factor. Does it change the retirement consumption factor? It does not. At the end of the day, near the end of your life, you still need the same amount of money. But what do you have to do to get there? You save more. The specific effect of low interest rates on consumption is far more muted. The ratio, the factor that translates through to additional purchases is far lower than anybody assumed, apparently, when they promulgated this policy. I mean, it seemed at the time, this is true. The reason I mentioned gasoline, because it seemed true of the factor of gasoline too, that the people doing the projections assumed that the whole thing would be spent. Now, why would they assume that? Because that's one thing that they wanted it to be. They have any empirical reason to believe that? No. Do they have any empirical reason now to believe that they won't? Yes, but will that affect their decision or their equations? Good question. Don't know the answer. It should. We have the empirical data in front of us that these additions to income, such as they are, will not be spent at 100%. So the effect, remember, it's my contention that the three policies, zero interest rates, quantitative easing, helicopter money, are all the same policy. At least as far as mentioned as direct financing of government spending in the Bloomberg article. Okay? So let's move on to one further consideration when it comes to the well-named helicopter money. Not as said in the Bloomberg article that direct financing government spending by the central bank, etc., that's already going on. I don't know why this particular author would write that as if this is a new policy. It's already going on. The BOJ buys essentially all of the government issued debt in Japan. There's any left for anybody else. It's getting so bad the government needs to issue more debt just so there can be enough to go around. Because government securities are bedrock of financial institutions on what they must hold. That's what they've got to keep on their books. Considered extremely liquid, they need to get rid of it, they can, on and on and on. It's true in the United States as well. When the Fed was running QE, they were buying almost all the debt there was. So there already is government financing, central bank financing. Shall we be realistic? Shall we be truthful? It's sleight of hand self-financing. Okay. So those three iterations, those three types of this policy are the same. And we have seen that there hasn't really been any sustainable, or frankly, in many cases, noticeable effect on consumption. Now, the reason this article mentioned this direct financing is because the type of, quote, helicopter money that's being considered in Japan, supposedly, is BOJ funding of another, endless, unnecessary, or at least endless infrastructure spending project. Which, there's hardly any, there's nothing new to this. Japanese government has been doing this for 20 years. But that's the type what they're talking about. Is there any difference if they issue the bonds into the market and then the BOJ comes in and scoops them up from the secondary market, or if they just send them right over to the BOJ and the BOJ prints money for them? I don't see there's any difference, frankly. But there is yet another aspect potentially to this policy. Not as spoken about in that article. Remember, in the US and Japan and other countries, the largest part of the GDP is composed of consumption, consumer spending, you and me and I, my kids, everybody, that's consumption. So instead of, and this has been spoken about, although I don't know if anyone's really talking about it, as far as an actual policy or deciding to do it, or even how you might do it, bypass the markets, bypass the effect, which we've seen is not really very effective, of interest rate policy, and go directly to the source. What's the source? The family budget. How do we do that? We send everybody a check. This is the ultimate of helicopter money policies. So far as I know, except in a theoretical sense, no one is talking about it. Now, there was a Fed governor, Cleveland, I think, I'd have to check, Mester, who in Australia last week, and I quoted this actually, was talking about this helicopter money policy as a policy which, if we find that quantitative easing has been ineffective, we could always do something like this. I don't remember exactly what it was. I saw this morning actually a retraction of that. Supposedly that's not what she said. I'm going to have to check this out. And of course, but that's exactly how it was reported and I read the quote. That looked to be what it was. Maybe it was out of context. I did not read the speech. Or was it a press conference? I think it was, I'm not sure if it's a press conference or speech. Anyway, there's been some sort of retraction on that, saying that's not what she meant. Okay, well, we'll wait and see on that. So will this policy, knowing what we've discussed so far, will this final version of the low interest rate policies, quantitative easing, helicopter money, whatever you want to call it, likely have any effect? As with zero interest rates, as with low gasoline prices, there is a disconnect between the behavioral economics, I'm not sure if that's the right use of the term actually, I think it is, of the way people and the vast majority of consumers, the population of the country, respond and what's expected. And as far as I can see, there isn't any reason to expect that a policy like mailing everybody a $2,000 check, courtesy of Uncle Sam, will have any different effect. You will get some sort of spending. It will, by experience of what we've seen, be far less than the economists, the government anticipates. But what's more important, it will be time limited. No one changes their permanent spending habits, their medium to long-term spending habits, which is what you need to change in order to have a sustainable effect in the economy, based on these types of policies. In addition, most of the people, I say this without any statistical proof of it whatsoever, understand the tenuous nature of the policies. Let's find another way to describe that. They understand that zero interest rates are not normal, and they're only at zero because there's a problem. They understand, even if they can't do the math, that when the government is deliberately driving interest rates lower, it isn't because everything's great. And they understand that when the government starts sending the money, that they're not doing it because of a heightened sense of altruism and love for their fellow citizens. They're doing it, all three of these policies, which again are the same policy, except for the last one. I mean, I would have to say that the idea of helicopter money sending people checks is a permutation enough so that it's actually a slightly different policy, because it attempts to short circuit the economic chain of events from low interest rates by simply providing money. So the results of these policies are, as we've seen, both limited for natural reasons, because people understand that they need to save more money, and two, because behaviorally, they reinforce a sense of unease. I mean, here in the United States, which what's been going on both in politics and in the country in general, there is a heightening sense of unease. And that is not going to be changed one whit by a government check. But even if that wasn't going on, it would be the same thing. We have seen the results. Japan has seen the results. And Japan's have, of course, the additional problem of demographics. But we have seen the results of what these policies do. They do not. And I'm not saying this in any capacity of judging the people who have executed these policies and implemented these policies. But what we've simply seen is that they don't have the effect that has been anticipated, that's been hoped for. We've seen the world's central banks essentially trapped by their own policies. And I don't think helicopter money would have any difference. Its ability to change the medium and long-term dynamics of a consumer-driven economy is minimal. It doesn't mean it won't be tried. And of course, likely place to be tried is Japan. But here, it would only, I think in the United States, I think it would only be tried were the economy headed or into another recession. Basically, because Fed doesn't have any other choice. You see, part of the logic driving these programs is the logic of necessity, or they feel it as the logic of necessity. The necessity being the need to act, to do something, backed by the belief that the Fed is actually the custodian of the economy and can affect, by good policy, the economy and get rid of all the bad and nastiness like recessions and stuff like that. And that's probably not the case. So the necessity is the bureaucratic need to act. But once you establish that that's the case, the extreme limitation of policy options. The Fed and other central bankers have been selling these policies as if they are different policies. Well, you know, low interest rates didn't work, so let's try something else, but it's not something else. Low interest rates didn't work, let's try quantitative easing. Same thing. Quantitative easing didn't work. Let's directly finance the government. Well, we're already doing that, but anyway, it didn't work. The purpose of low interest rate policy is to get consumers to spend more. We already know it doesn't work, at least not to anywhere to the degree that would promote a self-sustaining recovery of the kind that they want. It's very difficult to determine now whether the amount of growth we're seeing here in the United States for now almost a decade and around the world is because the economy is being supported by low interest rates. I mean, I would tend to think, considering the vapors that everybody gets when the Fed raised rates, that that's the case. But we've certainly seen, at any rate, that low interest rates don't produce the type of consumer spending, because if they did, we would have had the type of 3.5%, 4% growth that you normally see after very deep recessions. Did not happen. I know there's the Rogoff argument that their financial recessions are very different, balance sheet recessions are very different. I think there's probably some truth to that, but we're now close to 10 years after that and we're still in the same place. It hasn't changed. So the clear factor is interest rates cannot produce high or even moderate sustainable growth. That's in front of us. We can do what we want with it, is in front of us. The question, which I think maybe I'll try and examine in another webinar, is what's the chance that the interest rate policies are actually producing the drag on the economy? Again, going to be very difficult to prove, so I'm not sure I'm going to handle it. But I think the subsequent factor that we must reckon with, aside, of course, from the equity market, somebody starts dumping money on the Champs-Elysees and on Fifth Avenue in New York, equity markets are going to go through the roof, even more than they have. Whether that produces sustainable growth, I think we already have the answer. Interest rates don't. And consumers, when presented with the kind of additional income that the government expects to be spent nigh on 100%, don't. So interest rates, we know, don't produce sustainable growth. They don't produce an extra bunch of consumer spending. They don't start the cycle. We also know that free money doesn't either. Okay, folks, I thank you very much for attending. I will put my email into the chat. Actually, Adinda will. We will do another one of these sessions next Monday. Usually choose the topics by Wednesday or at the latest Thursday, and they go up on the FX Street site. If anyone has any topics that they'd like me to cover, I'll be glad to do so. Just send me an email. I'll put my email address in there right now. And Vida, would you send this over as always? And I'll be glad to discuss some topics that anyone chooses. Okay, thank you all very much for attending. I hope you have a great day. Wherever you are in the world, everyone take care.